Yo, what's going on, family? Welcome back to another episode of Tax Free Living, where I'm going to be teaching entrepreneurs just like you how to live tax free. And just so you know, guys, I'm absolutely loving doing this these YouTube episodes. I love that I am able to go deep into the topics of taxes, right? Deep into the various strategies, because on other platforms, I only get to give sound bites and snippets, where on this YouTube channel, I'm able to give the full story with the full details. If you're liking this as much as I am, please hit that like button, hit that subscribe button, and hit that share button, because as of the recording of this video, we're approaching 20,000 subs, right? So what I want you to do is look at that subscription number. If you don't see 20,000 subs, hit that subscribe button, right? Because then we're going for the next goal is 50, next goal is 100,000. Because we just understand the impact of this channel, right? Because we're giving you tax advice, we're giving you financial advice, and we're bringing in experts on our podcast, The Melanin Money Show, to give you tips on things outside of our scope of genius, right? And we really want this to be one of the leading financial education channels, and that only happens with your support. So if you've been enjoying it, hit that like button, hit that subscribe button, hit that share button, because we have an amazing episode today. And the title of today's episode is Top S Corp Write-Offs for 2023. You all know that an S Corp is my favorite entity, right? So I want to give you all the top 5 tax deductions that are related to S Corps. So let's first establish what an S Corp is, right? Because I get this question all the time. Guys, an S Corp is not actually an entity. Like, you can't just go start an S Corp, right? An S Corp is a tax election status that you're able to elect on your entity. So there are 2 ways to go about setting up an S Corp. You can create an LLC first and then have that LLC taxed as an S Corp, or you can create a C Corp and then have that C Corp taxed as an S Corp. So an S Corp is actually an election status, not an actual entity. So for most clients that ask me, like, which one do I want to do, or the easier way is to just set up an LLC and have it taxed as an S Corp. Now that we understand, the S Corp is just an election status, how do we do it, right? We file Form 2553. We've talked about this in other episodes, but I'm talking about it again today. File Form 2553, and you need to make that election for March 15th of the tax year, or 3 months after you create your LLC. So if you create your LLC in July, you have 3 months and 15 days after that date to make your S election status. If you don't, you have to wait until the next year. Now we know what S Corps are. So what are the 5 biggest tax deductions for S Corps? Let's start with number 1. It is not necessarily a tax deduction, but it's the reason that we set up S Corps in the first place, right? Because it's a major tax saving strategy. And so strategy 1 is S Corps allow you to avoid self-employment taxes. So the whole reason why we want to set up S Corp in the first place is because S Corp allows us to save a lot of money in self-employment tax. So let's give an example. If you have an LLC making $100,000, right? You're going to pay federal tax, you're going to pay state tax, but you're also going to pay FICA taxes, right? AKA self-employment taxes. Now, the self-employment tax rate as of 2023 is 15.3%. Okay, 15.3%. On $100,000 in net income, you will have a self-employment tax bill of $15,300 on top of federal and on top of state. But when we convert our LLC to an S Corp, we don't have to pay self-employment taxes on all of the net come from the business. We only have to pay self-employment tax on the salary that we pay ourselves from the S Corp as S Corp owners. So in this $100,000 example, the IRS says that we have to pay ourselves a reasonable salary, guys, right? Because if all the other money outside of salary is avoiding self-employment taxes, then people would just pay themselves no salary at all and completely avoid self-employment taxes, which is illegal. So the IRS requests you to pay a reasonable salary, and that reasonable salary can be anywhere from 30 to 50% of the net income from your business. So let's say in our example, we were making $100,000, but instead we upgraded our LLC to an S Corp. And let's say we paid ourselves 30% salary. That means we now have a salary of $30,000. We pay self-employment taxes on that $30,000, but the other $70,000 completely avoid self-employment taxes. So if you do $30,000 times 15.3%, our self-employment tax bill is only $4,590, right? Which is way better than the $15,300 that we were paying before. So if we do the math here, our tax savings just from upgrading our LLC to an S Corp is gonna be $10,710. So we save $10,710 worth of self-employment taxes simply by shifting from an LLC to to an S corporation. Okay, so that's the first strategy right there, right? That's the whole reason we want to become S corp is we want to save on self-employment taxes. The second strategy is taking advantage of the QBI deduction. So in the most recent Tax Cuts and Jobs Act, they introduced a new deduction called the QBI deduction, which stands for Qualified Business Income Deduction. And all this is a fancy word for we want to give S corp owners a tax deduction for being business owners. So how much did they decide on? Well, they decided on 20% of qualified income. So if we have $100,000 of qualified income, we get a $20,000 tax deduction just for being a business owner. When you're an S corp, you also qualify for this QBI deduction. Here's the thing I want you to be aware of. The QBI deduction has income limits. According to 2023, the income limit is $182,000 if you're single and $364,000 if you are married filing joint. So if you're single and making over $184,000, it reduces the amount of your QBI deduction. If you're married and you're making over $364,000, it reduces your QBI deduction. So one thing you also want to be mindful of is at the end of the year, looking at your net income line item. And if you're above that $180,000 of qualified income if you're single, maybe it's time to employ more tax saving strategies to get that income below the threshold so you don't miss out on this 20% deduction. Strategy number 3, okay? Strategy number 3, this is one of my favorite strategies because it allows us to build wealth and save on taxes at the same time. I'm actually gonna do a completely separate video about this in the future to dive deeper on this. So strategy number 3 is taking advantage of self-employed retirement accounts, okay? My favorite self-employed retirement accounts, especially as an S corp owner, is a SEP IRA or a solo 401k. And the maximum you can contribute to these retirement accounts is $66,000 per year. So let's talk about it. $66,000 per year. So if you decide to open up a solo 401k or a SEP IRA and contribute $66,000, not only are you investing $66,000, which means your net worth is increasing by $66,000. You also get a $66,000 tax deduction at the same time. So we're literally investing money to build wealth and simultaneously saving on taxes at the same time. So if you're an S corp owner, please set up your SEP IRA or a solo 401k. I'm gonna do a completely separate video on which one is better, depending on your situation, and which one I like more, and which one that I personally have. So that video will be coming soon, and let me know in the comments if you want me to make that video. Strategy number 4 is a strategy that you all hear me talk about a lot, and that is taking advantage of bonus depreciation. So what is bonus depreciation in the first place? Well, bonus depreciation, depreciation itself, right, is the IRS giving us a tax deduction for the wear and tear on the asset that we are acquiring. For example, on a vehicle, because your vehicle is going to lose value over time, it's going to have wear and tear over time, the government is going to allow you to take that deduction for that depreciation right now, right? So how much can we take? Well, with the recent Tax Cuts and Jobs Act, they increased the bonus depreciation to 100%, but they also put a clause in it. They said after 2022, it's gonna decrease by 20% per year. So we're currently in 2023, the deduction percentage for this year is 80%. So what that means is that if you buy an asset, a piece of equipment, a building, let's use a vehicle for example. If you buy a vehicle this year and you decide to use it for a business, 100%, right? You get to write off 80% of the cost of the vehicle in year 1. So if you decided to buy a Cadillac Escalade for your business because you needed a business vehicle, let's say the Cadillac Escalade was $100,000, you would get to write off 80% of that Cadillac Escalade this year, which means you will get an $80,000 tax deduction this year for buying a vehicle for your business. If you're an S corp owner, you do not want to miss out on bonus depreciation, especially the fact that it's decreasing by 20% every year. So in 2024, it's only going to be 60%. In 2025, it's only going to be 40%. So not only do we need to take advantage of this deduction, we need to be taking advantage of it right now. Strategy number 5, which is one of my favorite strategies, is taking advantage of the Augusta rule. We did a whole separate episode on the power of the Augusta rule and how to take it. If you missed that episode, please go back to our previous episodes and check that episode out, because I'm not gonna go in deep into it. I'm just gonna give a high level example of what the Augusta rule is. The Augusta rule allows you to rent your primary residence to your business for up to 14 days a year. On top of this, the money that the business pays for the rental is tax deductible to the business, tax deductible to the S corp, and the income received is tax-free to the owner. So let's do a quick example. If I am an S Corp owner and I own my property, I can rent it out to my S Corp, right? And let's say I look around and find comparable rent rates that say you can rent out this primary residence for $500 a day. So I can rent out my primary residence to my S Corp for 14 days a year at $500 a day. That is $7,000. So my S Corp gets a $7,000 deduction for rent, and I get $7,000 worth of income to me tax-free. So I'm able to use my residence to create tax deductions for my business and create tax-free income to me. And that is the power of the Augusta rule. Those are the 5 top S Corp tax write-offs in 2023. Switching to S Corp to save on self-employment taxes, taking advantage of the QBI deduction, self-employed retirement accounts, taking advantage of bonus depreciation, and leveraging the Augusta rule. So guys, if you enjoyed this episode, if you liked it, if you learned anything, please hit that like button, please hit that subscribe button, please hit that share button, and I'll see y'all next time. Peace.